Hey friends, welcome back to my channel. If you're new here, my name is Bianca, and today we are going to talk about how we can analyze real estate investment trusts or REIT property purchases to determine if they are a good purchase or not. You see, REITs are a special type of investment vehicle that essentially owns income generating properties such as malls, offices, or even warehouses. And one of the ways that they can grow their portfolio is by basically buying more properties. However, we do have to remember that not all property purchase is necessarily a good one. Just by buying a lot or even the wrong kind of property can actually hurt the REIT and its investors. So, how do you spot the truly good deals? To help you evaluate, I've put together a very simple checklist of 4 key points. We'll just call them, 4 signs of a strong REIT acquisition. So, sign number 1, the acquisition price itself. Basically, what you need to do is to just ask yourself, did the REIT pay a fair price to buy this property? Or even better, snag a bargain? Many REITs, especially in Singapore, do report independent valuations on the property that they are planning to acquire. So it's good to make sure that the acquisition price aligns with or perhaps is even below the valuations. And if you ever happen to find yourself attending any of these analyst conferences or briefings about the proposed acquisition, I suppose it's always good to always look out for clear explanations from the REIT's management as to how they first arrived to that purchase price point and why they believe that this property purchase is good for you as investors. Next, we have sign number 2, the impact of this acquisition on investors' return, as well as the financing approach. Now, for income investors, this is key. So when the REIT buys a new property, we will want to see if this acquisition actually increases the amount of cash you receive per unit you own. So this is what we call as the distribution per unit or DPU accretion. This means that this new property to the portfolio should be adding to the REIT's total income more than it costs, meaning to say that you will receive more distributions, aka dividends, into your pocket. Meanwhile, how the REIT pays for the acquisition is just as important. So REITs typically use a mix of debt, aka borrowing money, or equity, meaning to say the issuance of new shares, or even sometimes what we call asset recycling, meaning to say that they sell off an existing less strategic property in their portfolio in order to fund their property acquisitions. So under very extreme circumstances, there are situations where REITs may issue too many new shares or offer them at a massive discount, which may essentially dilute the existing unit holders' ownership. So in very simple terms, this basically means that the cash per unit gets spread across way too many new shares, and then for existing unit holders, this may mean that the profit that goes into their pocket may actually not increase, or it could even shrink. On the other hand, taking on way too much debt can also be a very financially risky move for the REIT. So the things that you will want to look out for as an investor is to see if the REIT is offering a financing plan that is beneficial or basically fair to the existing unit holders. So some REITs may actually offer existing unit holders a chance to buy the new shares at a reasonable price or perhaps at a slight discount. Besides that, it is important to also check the REIT's overall debt levels, aka its gearing ratio post-acquisition, to make sure that they are healthy and manageable. Now, let's move on to sign number 3, where we talk about the lease itself, the tenants of the property that the REIT is going to purchase, as well as the quality of the location. So one of the things that I have regurgitated in a few videos of mine would be that a REIT's primary income would essentially be rent. And for investors, you will want that income to be stable and predictable. That said, one of the things that you could look out for would be long lease agreements. These can be a good sign of stability because they essentially locked in a long period of rental income. That said, you will also want to make sure that the tenants the property is being rented out to are strong and reliable financially. Basically, make sure that the companies or organizations that you're renting out to pay their rent on time. And finally, a property's location matters immensely. Basically, a property that's located in a high demand area would allow it to command good rent over time and make sure that it is consistently occupied. For example, let's just say a healthcare REIT acquires a hospital, we will want to make sure that the hospital is run by a reputable healthcare provider, and to also make sure that that hospital is located in a place where there's a growing demand for medical services. So this combination of long lease, which in this case is commonplace for healthcare providers, where their lease can last up to maybe say 10 to 15 years or perhaps even longer, on top of having a prime location, would essentially translate to steady and predictable dividends into your pockets as investors. Last but not least, we have sign number 4, strategic fit and future potential. So this criteria is all about figuring out whether this property actually fits in well with what the REIT is usually good at doing, and whether this property has good potential in the future to, let's just say, improve the rental rate or attract better tenants, etc. So to give a very random example, let's just say you have a REIT that specializes in acquiring warehouses. It just doesn't make sense for it to one day suddenly acquire a hotel, even though that acquisition is profitable. You'll want to see REITs that are buying properties that align well with their overall plans and are also in growing areas. Like if data centers are booming because of AI, well, a data center REIT buying more data centers would then make perfect sense. Essentially, the whole ideology behind this is that you want the REIT to have a strong focused portfolio that is well built for the long term. Alright, so now let's try to make this real with an actual example. So I'm going to talk about this Singaporean REIT called Keppel DC REIT, which acquired 2 major data centers in Singapore. Okay, I kind of wish that it gave a little more exciting names for these data centers, but okay, they called these 2 data centers KDC SGP 7 and KDC SGP 8. Now, if you're not very familiar, this REIT called Keppel DC REIT is quite a big name in the data center REIT universe, especially in Singapore, which is essentially a major global hub for these kinds of facilities. In simpler terms, this REIT basically specializes in owning stable and high quality data centers. So here's a quick rundown of the deal. So the REIT basically bought itself 2 hyperscale AI-ready data centers in Singapore, and they bought this from their sponsor called Keppel for a price of 1.38 billion Sing dollars. And how they're paying this is basically via a mixture of new shares and debt. And these new shares are in 3 forms. So what we call the private placement, which basically means that the REIT has sold shares to selected institutional investors as part of their fundraising process. Preferential offering, well, a fancy way of basically saying that their existing unit holders were given a chance to buy additional shares, typically at a discounted rate to support the acquisition, as well as what we call the sponsor subscription, which basically means that their parent company, Keppel in this case, has chipped in by purchasing shares to show, their commitment to this deal. Now, let's run this acquisition to our test of the 4 signs, or 4 factors, or 4 aspects, however you want to call it. Number 1, let's dive into the price. So Keppel DC REIT is basically acquiring almost all, 99.49% of these 2 data centers for 1.03 billion Sing dollars, which is actually below independent valuations by expert valuers such as Knight Frank and Savills in this case. So that's a great start, because it means that the REIT is getting a fair deal, or possibly even a bargain, which is essential for protecting investor value. Now, the price could go up to 1.38 billion Sing dollars if the REIT gets approval to extend the land lease by 10 years. So this extra cost could include an additional payment of 350 million Sing dollars for the extension. And even with this potential hike, the price remains within or below these evaluations, which is always reassuring for investors. Now let's move on to the next criteria, where we assess how the REIT is financing these 2 acquisitions and how this acquisition would essentially impact the investor's return. So basically, these 2 data centers are expected to increase the payouts that investors receive, with a projected boost of 8.1% in terms of the DPU, or distributions per unit. But this is provided that the land lease is indeed extended and certain tax benefits are obtained. So to pay for this deal, Keppel DC REIT is using a mixture of funding sources. So by raising money by issuing new shares, as well as receiving support from their parent company, as we discussed, along with borrowing some money. Despite taking on some debt, their overall debt level, or in this case gearing as I mentioned, is expected to improve, dropping from 39.7% to 33.3%. This basically translates to the company having more financial breathing room while still keeping its financials in good shape. Next in line, let's talk about the lease, tenants, as well as the quality of the locations. So these data centers are basically what we call as hyperscale facilities, and the demand for such spaces is skyrocketing. So both centers are fully leased to top-tier global tenants, which are essentially the big players in cloud computing and tech, and these ultimately ensure a steady and reliable income stream. The average lease commitments for these two facilities are about 3.9 years, or let's just round up to 4 years, for KDC SGP7 and 5 years for KDC SGP8 as at September 2024. While this might not seem like a long duration, the quality of these tenants and the surging demand for hyperscale data centers do provide a solid foundation for stable returns. And adding to this, these data centers are actually located in Singapore's leading data center campus, which offers outstanding connectivity and is actually designed to support cutting-edge AI applications as well as sustainability goals. So you can think of it as this combo of top-tier tenants, the strategic location, as well as the future-ready infrastructure would make this a very strong setup for the REIT's predictable income as well as long-term growth. And this brings us pretty seamlessly to number 4, where we talk about the strategic fit and future potential. So does these two acquisitions align well with Keppel REIT DC's strategy of focusing on, high quality AI ready data centers in Asia's top data hub? Yeah, I could say so, because the deal basically boosts their asset under management, or AUM, from 3.9 billion Sing dollars to 5.2 billion Sing dollars, and thereby strengthening their market position. On top of that, these properties are actually built with the future in mind because they are really well equipped with handling demanding AI workloads, as well to basically address sustainability goals. So based on this checklist, I guess we can kind of come to a conclusion that Keppel DC's REIT acquisitions of these two properties does look like it's a fairly reasonable and smart move. So to wrap up, I like to think that understanding these 4 simple points are essentially a good stepping stone to help you become a smarter REIT investor. So to recap, number 1, is the acquisition price fair? Number 2, how does this impact the investor's return, and is the financing fair? Number 3, what is the quality of the leases, tenants, and location? And number 4, does it fit with the REIT's strategy and future potential? So I hope that this simple checklist can give you a rough guiding point as to how you want to assess future REIT acquisitions. But remember, I am just making a simple YouTube video for educational purposes, and this can never be taken as actual investment advice. Because you gotta remember that each and every acquisition does have its set of nuances, so it's highly important for you to do your thorough research or to maybe consult an actual professional before making any major investment decisions. That's it. I do hope that this breakdown offers a simple yet helpful starting point, and if you do agree with that, I would really appreciate if you could hit the like, subscribe, and bell icon, because trust me, it really helps to support the channel. And if you're interested, do check out a video I've made previously on how REITs value commercial real estate. On that note, thank you so much for taking the time to watch my video. I hope that you enjoyed it, and I shall see you in my next video. Bye bye!